Good afternoon and welcome everyone. The topic we will be discussing today is based on how to measure bank credit risk disclosure, a paper by Scanella and Palese. My name is Abdullah bin Zaman, and with me are Kelly and Luis, and this presentation will be subdivided into several parts on the key disclosure research designs, credit risk management techniques, key disclosure issues, key aspects of credit risk management, and correlation-based network analysis. To begin with, I will briefly discuss with you the key points of this paper. Have you ever heard of this famous saying, credit ratings and risk ratings must undergo a thorough process of review and revision? The quote should ring a bell because credit risk disclosure is all about how management of the entity's financial statements should be able to assess the nature and amount of risk emanating from financial instruments to which the business is exposed at the end of the reporting period based on the information provided by the management. Thus, further review and revision done will help to boost the efficiency of financial markets and promote financial stability. Now, credit risk disclosure is very important because it helps to reduce the asymmetric information among stakeholders and limit the amount of problems coming from the different interests. It also helps to strike a balance between divergent interests and provides an opportunity to improve depositors and investors. To further discuss on credit risk disclosure in banking, there are several new methodological approaches on how to evaluate the credit risk disclosure. The research carried out in this paper had investigated the 10 largest Italian banks of their total assets, and in terms of total assets, these financial institutions account for over 60% of the Italian banking industry. It was discovered that the majority of these banks use a commercial banking business model, which emphasizes the strategic importance of credit risk. The data collection of the research consists of a thorough examination and evaluation of the three important risk disclosure reports, which are known as the notes, the management commentary of the annual reports, and the Basel Capital Accords Pillar 3 report. New insightful approaches were used, such as reviewing all the annual reports of the 10 banks from the time frame period from 2012 till 2017. The research was based on separating the scoring model into two pieces to reduce the subjectivity that can affect this type of study. The first component is based on an objective assessment, while the second is based on a judgment evaluation. The end result is a hybrid scoring methodology that uses a semi-objective evaluation strategy to examine qualitative and quantitative data, which provided the scoring model is appropriate.
There are few credit risk disclosure issues. The first one is there are banks that concerns on importance of the comprehensibility and clarity of the credit risk reporting, while others underestimate the importance to provide the definitions and explanations of the credit risk measurement. Precise risk describe the bank activity, credit risk exposures, driver, and methodology by how the bank manage the credit risk. Credit risk reporting should be well organized and easier to search by the supporting of chart, graph, and cross-reference. Comprehensibility helps stakeholders to understand bank credit risk positions and management operations. And some financial institutions only provide an English version of key term or parameter, while other banks provide both versions. The glossary should provide a clear and synthetic definitions of all specialized terms concerning credit risk measurement, parameter, and result. Our bank of the sample achieve a low finance score. Under reporting strategy that affect the comprehensibility of the information provided and the disclosures of the methodology that support risk measurement approach calculations upward. Lastly, the information on stress test result change frequently over time, such as 1 year a bank provide information in the notes, year after provide in the management commentary, again the years after no information is reported. This variability affect the comparability over time and make it difficult to compare the credit risk profile of different banks. Financial institutions need to reduce disclosures instability and provide homogeneous information on stress test risk. There are few key aspects of credit risk management and banking. An adequate disclosures on hedging strategy is crucial for assessing whether a bank is really protected against credit risk. The explanations of bank credit risk management strategy require the disclosures of expected management scenario, expected economy and financial conditions, risk propensity, and emphasis on how credit risk can affect bank management decisions and performance. Besides, the explanations of bank credit risk management requires the disclosures of risk management goal, procedures, process, and policies, a description of the main result of new credit risk management functions, an analysis of the key driver of bank credit risk and their impact on funding, investing decisions, and results. A description of the relationship between credit risk management and bank general risk management issue. The disclosures on current on-balance sheet credit risk exposure is more informative than that on potential and off-balance sheet credit risk exposure. Financial institutions tend to provide information on risk measurements that are merely based on accounting results or computed for bank regulatory purposes. If credit risk measure and other quantitative data are not adequately supported by quantitative information, the disclosure could become uninformative for a complete comprehension of bank exposure to credit risk. Financial institutions pay more attention to the credit risk capital adequacy, adopting a regulatory perspective rather than an internal and managerial approach. There are three different levels of disclosure fragmentations. The first one is risk reports level, second one is credit risk level, and then lastly is the bank level. Risk report levels is related to the existence of different risk disclosures documents characterized by different level of details, contents, and scope. Those reports are often not sufficiently integrated or cross-referenced with each other, and they are characterized by several instances of overlapping information. Besides, credit risk levels is associated with the inadequate provisions of holistic view on key aspects of credit risk management decisions, credit risk exposure, credit risk component, and credit risk measurement, credit risk mitigations, transfer instrument, loan portfolio, and risk capital requirements. The lack of an integrated perspective could compromise the understanding of the interactions of different credit risk factors. The potential impact of change of credit risk variable, the effective of credit risk measurements, strategy, policy, and instruments, and their impact on lending business, bank performance, capital, and liquidity constraints. Lastly, bank level is related to the lack of adequate analysis and explanations of the interconnected and interactions among different kinds of risk. The disclosures of all banks of December is characterized by these three levels of fragmentation to some extent. These fragmentations reduce the capability of the user to assess the implications of the credit risk in the bank economy and management. In order to enhance the provisions of an integrated view on credit risk and in a wider perspective on banking risk, it will be advisable a better integration between the different risk reports or the provisions of a single risk report that provide a coherent and global explanations of bank risk. These appendix would eliminate the information's operating links between the risk disclosure document. A reduction of the disclosure volume and increase of its desirable attribute and the provisions offer parsimonious presentations in order to make risk disclosure less burdensome is fundamental to tackle this problem, as we observe an increasing risk reporting volume over years for almost all banks of the sample. And the disclosure fragmentation is positively associated with the volume of risk reporting. The excessive detail on credit risk, the higher number of bank of credit risk reporting, and lack of summary reports and cross-reference do not allow the reader to have unified view on credit risk in banking. A provisions of different level of complexity of the risk reporting in order to balance the trade-off between the levels of detail of the information on the one hand and the information needs of the different type of stakeholder on the others. An adequate use of graphs and charts could reduce the complexity of the analysis, provide an integrated perspective on credit risk, support the comparison between different financial institutions, and synthesize key concept measures and results.
Research suggests the sample of banks chosen for the credit risk disclosure is more backwards-looking than forward-looking. The level of information provided by the bank on potential credit risk exposure, stress tests, scenario analysis, expected capital absorption capacity, possible credit risk management strategies, and policies is low. Financial statement users are unable to assess the bank's possible credit risk exposure and know the actual capacity of the bank to bear more credit risk. In addition, there is no connection between the bank's strategic and risk management aims, and expected performances with capital needs and capacity to bear additional risk. The implementation process of IFRS 9 resulted in more accurate stress test description, which led to an enhanced sensitivity analysis. The analysis of the possible impacts of IFRS 9 enhanced the forward-looking information on bank credit risk. The main aspects of forward-looking information that saw improvements due to the IFRS 9 were rating quantifications, mitigation risk, insolvency risk, recovery risk, provisioning for loan losses, possible credit risk exposure assessments, implications of internal credit rating for bank management, and analysis of non-performing loans. The authors of the paper have a few suggestions to continue improving forward-looking perspective, and they are a higher degree of qualitative and quantitative disclosure on future scenarios of business and competitive position, as well as more information on the bank management and credit management strategies. Disclosure on the expected capacity of the bank capital to bear more risk. Provision for more stable, homogeneous, and comparable information on stress test results and their impacts on financial institution strategic decisions, potential credit risk exposures on and off balance sheet, credit risk loss, economic and financial performance, as the disclosure of stress tests changes significantly over time and across banks. Provision of a complete analysis of the expected management decisions to be implemented to ensure bank capital adequacy on credit risk over time. The management commentary is a mandatory report intended to complement and supplement the annual financial statements. The document could overcome the limitation of the bank financial statement and improve the user's ability to make better economic and financial decisions if used to its full potential. Unfortunately, many banks from the sample do not see the benefits of the document. The management commentary is a forward-looking approach that offers an integrated disclosure perspective on the bank risk strategies, risk management, risk measurement, and internal risk control, enhancing credit risk disclosure quality. However, the document's lack of standardization could lead to negative consequences such as comparability across both banks and over time, and latent semantic dimensions of the texts. There are also substantial differences in communication and writing styles, which current accounting rules impose only a minimum content of the document, but no specific configuration or structure. In 2010, the IASB issued the Management Commentary Practice Statement, which provides a broad, non-mandatory framework for the document presentation. The focus was on what is relevant for the unique circumstances of the bank: historical financials, business description, management information, and market data management perspective. The level of detail in the document is at the bank management's complete discretion, and thus the credit risk disclosure in the management commentary may not be sufficiently comparable and lack details. Therefore, the document could hide poor performance of the bank management, increasing bank opacity, and cause misperception on the credit risk. Hence, the annual report users cannot adequately evaluate bank credit risk exposure. Providing more information may not be necessary, and it does not necessarily increase in the information's transparency. The correlation matrix creates a network where banks are the nodes, and the correlation represents the links, but excludes a non-significant correlation coefficient. Two different approaches were used to create a statistically validated network. The traditional approach considers each test as a standalone test and sets the confidence level at 1 minus alpha for each. The values that are not statistically significant have a confidence level of 5%. The family-wise error rate, which is also known as the Bonferroni method, which considers the statistical significance of the whole network and sets the confidence level at 1 minus alpha divided by the number of tests of the procedure. The procedure guarantees that the probability of wrongly rejecting at least one null hypothesis of no correlation is less or equal to alpha. It is the most appropriate approach because it is possible to control the type of one error of the whole procedure, even if it is a very conservative approach. The relationship between bank scores, bank size, and the dimension of the notes. Intesa Sao and UniCredit are highly correlated and the largest banks in the sample. It was reasonably assumed that those banks are more capable of adjusting their financial reports model to fulfill regulatory requirements and investors' needs of information. Large banks operate in more sectors than smaller ones. Thus, their financial reporting should reasonably provide information about a wide range of topics. The evolution of large banks' risk reporting over time is different from smaller banks. The two medium-sized banks, Banco Nacional del Lavaro, has 3 links, and Banco Popular di Vincenze has 4 links. Banks of similar dimension tend to react more or less uniformly to external stimuli, such as changes in the regulatory framework or shareholder and stakeholder concern. The analysis was affected by the assumption that the scores are normally and independently distributed. To address the concern, a robust test was carried out. The other option was to assess the statistical significance of the correlation coefficient without any assumption on the score distribution based on the permutation of bank scores over time. The greater the number of permutations, the more accurate the estimation. 1 million permutations were computed to make the estimation reliable. To conclude, the paper suggests using a methodological tool to analyze the credit risk disclosure in the bank's financial report based on content analysis framework described by Kirpendall. This innovative method provides empirical preliminary evidence on the bank's credit risk disclosure practices. Financial institutions are subjected to stronger market discipline and the enhancement of bank credit risk disclosure. It will contribute to broader financial stability. The authors also believes that adequate and effective transparency of bank risk profiles will inspire a sense of trust in the banking industry by decreasing the uncertainty of the bank's risk assessment. Hence, a better knowledge of credit risk in banking would enhance financial market transparency, stability, and market discipline as marked by the new Basel Capital Accord, Pillar 3. The authors argue that there is room for improvements of the disclosure and the transparency of information to strengthen the bank's system's stability and the effectiveness of the market disciplines. The bank could adopt a correlation-based network analysis approach because there is a relationship between credit risk disclosure, bank size, and business model. Banks can mitigate various concerns on the subjective evaluation that affects the content analysis. A hybrid methodology should be used. This hybrid methodology will overcome the drawbacks of purely quantitative and qualitative analysis. It can be applied to investigate risk disclosure in banking and other fields. Another use of would be to analyze the effects of risk disclosure on bank performance and identify the main determinants of the bank's risk disclosure, because the content analysis is the most widespread, suitable, and reliable method to analyze quantitative and qualitative aspects of risk disclosure. The author's credit risk disclosure index can be used to analyze the relationship between disclosure and idiosyncratic risk, which refers to the inherent factors that can negatively impact individual securities or a specific group of assets.